all. Welcome to video lectures by Shivananda Sharma Memorial RV College. SSMRV College, one of the premier institutions run by the prestigious RV group of institutions, has come up with a unique initiative to engage students at the time of this unforeseen medical emergency caused by corona outbreak. As a socially responsible institution, we would like to connect academically with students to make good the losses caused. In this connection, I, Vidya Jambagi of Department of BCom has posted a video on the subject Advanced Financial Accounting on the topic Consignment Accounts. Please watch the video till the end and like, share with your peer groups and subscribe to our YouTube channel. Thank you. This video lecture is a continuation of my previous video lecture on consignment accounts. In my previous video lecture on consignment accounts, we discussed about the meaning of consignment and the important terms used in consignment. In continuation of the same, the next term is recurring and non-recurring expenses. So when the consignor sends the goods on consignment to the consignee, there are certain expenditure which are incurred both by the consignor as well as the consignee. Now these expenditure would be while transporting the goods or bringing the goods into saleable condition or any such expenses which will help in selling the goods that are consigned. So these expenses are of two types: recurring expenses and non-recurring expenses. So first, what are recurring expenses? All the expenses incurred by the consignor and the consignee which do not increase the value of goods are called recurring expenses or indirect expenses. So as the name suggests, recurring expenses means those expenses which keep recurring, which are recurring in nature, which do not increase the value of the goods. They are also referred to as indirect expenses. So the examples, I've listed out a few of the examples. Expenses on goods returned by consignee, bank charges for discounting bills incurred by the consignor, and godown rent, insurance, selling and distribution expenses, etc. incurred by consignee. Non-recurring expenses. All the expenses incurred till the goods reach the premises of the consignee and the expenses incurred to bring the goods in a saleable condition are treated as non-recurring expenses or direct expenses. So, they are referred to as direct expenses also, and they are incurred only once, that is at the time of sending the consignment. So that is why they are called as non-recurring expenses. So these expenses increase the value of the goods and hence are added to the cost while determining the value of closing stock. So again, these expenses may be incurred either by the consignor or by the consignee depending upon the terms of the agreement between them. I've listed out few examples for the non-recurring expenses: freight, insurance in transit, packing, carriage, loading charges, etc. All these are incurred by the consignor, and freight to go down, insurance in transit, carriage to go down, unloading charges, etc. incurred by the consignee. Next important aspect in consignment accounts is the treatment of losses in the books of consignor. When the consignor sends the goods to the consignee on consignment, there are chances that he may incur some losses when the goods are in transit or till the time the goods reaches the consignee. Such losses affects the consignor. So since consignor is the owner of the goods, so the losses also affect only the consignor and not the consignee. So these losses are to be accounted for in the books of the consignor. These losses are of two types, normal loss and abnormal loss. So first, what is normal loss? When goods are lost or damaged due to normally expected but unavoidable causes, then they are referred to as normal loss. So that is, normal loss is an unavoidable loss. It is such a loss that takes place because of the inherent nature of the product. So the very nature of the product is such that it is bound to incur some amount of loss which is unavoidable. For example, petrol. Now petrol, the moment you open the lid, it gets evaporated. So this is something unavoidable. So such loss occur due to leakage, evaporation, drying, etc. So normal loss occurs due to leakage, evaporation, drying or any chemical reaction which is unavoidable while processing or while transporting the goods. So normal loss again is not separately accounted for. We don't calculate the value of normal loss separately. The cost of normal loss is observed by good units. So that is why normal loss is not calculated separately. So let us understand this concept with the help of an example. I have taken up a simple problem here. Mr. Ram consigned 100 kgs of apple to Mr. Lakshman, the cost being rupees 60 per kg. Ram incurred freight charges of rupees 8,000. The loss of 20% is unavoidable. Calculate the cost per kg of apple. So Mr. Ram is the consignor and Mr. Lakshman is the consignee. Mr. Ram has consigned 100 kgs of apple and the cost per kg of apple is rupees 60. Mr. Ram, who is the consignor, has incurred freight charges of rupees 8,000. So this is the non-recurring expenses of consignor, which is a direct expenditure. So this adds to the cost of the goods. The loss of 20% is unavoidable. So that means it is normal loss. So since it says unavoidable, it is nothing but normal loss. So we are asked to calculate the cost per kg of apple. So cost of 100 kgs of apple is 100 into rupees 60 per kg, which is 6,000, plus we add the non-recurring expenses of the consignor, which is rupees 8,000. So therefore the total cost is rupees 14,000. Now this 14,000 is to be distributed only by or only to the good units, because the problem says 20% is unavoidable loss. So out of 100 kgs, 20% is normal loss. So that is 20 kgs is normal loss. So I cannot distribute the total cost by 100 kgs because out of 100 kgs, 20 kgs is lost. Only 80 is left out. So 80 is the good units. So 14,000 divided by 80 kgs. So that means rupees 175 per kg. So the normal loss has increased the cost per kg of apple. Now if there was no normal loss in this given problem, the cost per kg of apple would have been rupees 140. That is 14,000 divided by 100 kgs. Now since we have normal loss, we are dividing the cost, the total cost only by the good units. So thereby the cost per kg of apple has increased, and now the cost per kg of apple is rupees 175 because of normal loss. Next, abnormal loss. When loss or damage of goods is caused by unnatural or unexpected reasons, then such loss is treated as abnormal loss. So that means abnormal loss arises due to unavoidable circumstances like fire, floods, earthquake, theft, accidents in transit, etc. But abnormal loss is accounted for. So we calculate the value of abnormal loss. So abnormal loss can be insured as well, and abnormal loss is valued at cost price. So let us understand the calculation of the value of abnormal loss with the help of an example. So I have taken up a small problem here. Suresh of Bangalore consigned 2000 bags of rice to Rajesh of Mysore costing rupees 400 each. So Suresh incurred expenses of rupees 4000. Rajesh incurred godown rent rupees 2000, selling expenses rupees 2000. 200 bags were lost in transit. Calculate the value of abnormal loss. So Mr. Suresh is the consignor and Mr. Rajesh is the consignee. So Mr. Suresh has consigned 2000 bags of rice to Rajesh, and the cost of each bag is rupees 400. Suresh, who is the consignor, has incurred expenses of rupees 4000, and Rajesh, who is the consignee, has incurred godown rent 2000 rupees and selling expenses also rupees 2000. So 200 bags were lost in transit. So that means this is the abnormal loss units. So calculate the value of abnormal loss. So goods sent on consignment is 2000 bags costing rupees 400 per bag. So that comes to rupees 8 lakhs. To this we add the non-recurring expenses of consignor, which is 4000. So as we understand, non-recurring expenses are the direct expenses which adds to the value. So thereby we add it, so which is 8 lakh 4000. So cost of goods in transit is rupees 8 lakhs 4000. Considering this, or taking this into account, 8 lakh 4000, we calculate the value of abnormal loss in transit. So 8 lakh 4000 into the number of units lost in transit divided by total number of units consigned. So that is 8,04,000 into 200 divided by 2,000. So 200 is the abnormal loss and 2,000 is the total bags consigned. So the value of abnormal loss in transit is rupees 80,400. Selling expenses and godown rent are considered as recurring expenses. So that is why they are not added to the cost here. Let us look into the differences between normal loss and abnormal loss. Normal loss, it is caused by normally expected or unavoidable causes like evaporation, leakage, loading and unloading, etc. Whereas abnormal loss are caused by accident, human carelessness or negligence. Normal loss need not be separately accounted for, whereas abnormal loss must be accounted for separately. Normal loss is not valued and it cannot be insured, whereas abnormal loss can be insured. Thank you for watching the video.